Interestingly, I've been the CEO for 4 years now. And the first thing we did was the hardest thing, and we sold Sikorsky. And Sikorsky was, again, it's a good business, but it's a very long cycle business, but it's 100% defense, and really didn't fit in with where we wanted the business to go. It didn't have the growth, and it had high risk in some of the programs. So remember, we did that back in 2015, in March. The fallacy or the learning for us and for the board, I think, during this process, and we studied 74 different spin transactions that have occurred in the last 10 years. And what we looked at was, what are the cash flows of the business over time, and can the businesses support themselves with the cash flows in order to make enough investments to sustain growth? And the fallacy in our thinking was that you needed cash flows from Otis and Carrier to pay for the investments in Pratt & Whitney and the aerospace systems business, right? You're going to build a $10 billion engine, you need cash coming from Otis and Carrier. The fact is, when we looked over the last 10 and 15 years, the cash flows from the aerospace business more than covered all of the R&D, all of the CapEx, and their share of the dividend. So there was no cross-subsidy required. And it was, I think that was the magic moment when the board said, we don't really need to be together. Then the question is, should we be together? And again, as we started looking at the other spins, these 74 spins that have occurred, what we saw is a high preponderance, 80+% of these businesses that you spin off do better in the 3 to 5 year period after the spin than they were doing pre-spin. And I attribute it to one thing, and that's focus. Right? You know, we can talk about capital structure and capital allocation and different investor base, but I think the focus of a management team on that business is what will drive the results.
So what's the argument now for the modern conglomerate? What's left?
Well, I guess you'd have to talk to Mr. Buffett about that.
or Mr. Culp.
Or Mr. Culp. But I think, look, Larry's going through the same process, I think. And you know, GE, different animal than UTC, right? Much more complicated, had a financing arm, things that we don't have. So our split here is actually quite simple, complex in the tax restructuring, but in terms of separating, we already have 3 businesses that run by themselves. Our goal now is just to set up 3 public company headquarters to support those businesses.
Greg, it's going to cost a bit more than some had anticipated. I think that's why the stock is looking down in the open. You say between $2.5 and $3 billion in one-time costs. Can you run us through why that number is seemingly larger than some had anticipated?
So you break it down, there's 3 pieces of that cost. There's about $500 million, I would say, in true one-time cost, and that is to set up the IT and tax structures to run the business. So today we've got a single IT structure for all of UTC. You got to replicate that 3 times. One treasury system, replicate that tax system. So a huge amount of IT investment. The second big piece is tax restructuring. We've got about 1,200 legal entities around the world. We've been optimizing the tax structure to minimize taxes globally. Well, all of a sudden, you've got to restructure each one of those 1,200 entities and break it up between Carrier, Otis, and UTX. So that's going to take a long time, about 18 months, and that is probably $2 billion of cost.
Wow.
There are transfer taxes to be paid in almost every jurisdiction. Okay. Now, the reason it's going to take us 18 to 24 months is we're trying to minimize that cost, and I hope when we're all said and done it's lower. But we didn't want to surprise anybody and come back and say, hey, there's another $500 million here. So tried to be conservative in the upfront.
Candidly, Ed Breen is saying that the costs did come in lower for Dow DuPont. I have to believe that you'll be able, given your bean counter history, do better than that.
Look, under promise, over deliver.